Welcome to Chapter 17 of the Canadian Securities Course, Volume 2. In this chapter, we are going to be looking at mutual funds and specifically the structure and regulation of mutual funds. So first off, I do want to discuss managed products in general. Mutual funds are a type of managed product, but they also are things like ETFs, segregated funds, liquid alternatives, things like that. And managed products, they can be either active or passively managed. Active management basically just means that the fund managers are actively managing the fund, so they're making decisions based on their outlook of the market and the securities that they invest in, and they try to outperform a specific index by using active management, whereas passive management is something that a lot of ETFs use. They don't make their own security selections. Instead, they basically sort of try and copy an index based on weighting and the specific securities within it. And their goal here is to replicate the returns of a certain market index. Now, as I mentioned, some of the examples of managed products include mutual funds, ETFs, segregated funds, liquid alternatives, hedge funds, listed private equity funds, closed-end funds, and the labor-sponsored venture capital corporations. And the advantages here of managed products is that they do have professional management. So what this means is that you do have professionals watching over these funds, so they are picking stocks based on a lot of information. They're doing a lot of analysis, and they probably are more qualified to make selections. So there is, that professional management aspect of things. Another advantage includes the economies of scale. So this basically means that managed products, they do pool a bunch of funds together, and when you do that, you are able to purchase. You have more purchasing power, so you are able to purchase more securities, and basically you can get lower cost versions of things with the economies of scale, and also the low cost diversification. So since you are pooling money together, you are able to sort of diversify yourself within the market by using less money. So it is a low cost to diversification, since you can easily put maybe $1,000 into a mutual fund, for example, and this mutual fund is invested into, let's say, hundreds of different stocks. And on your own, you couldn't do that with your $1,000. You just mathematically couldn't invest your $1,000 into 100 different stocks. Another advantage is the liquidity and flexibility. So all these managed products, they are quite liquid. You can buy and sell them with limited restrictions. There is a 90-day trading fee on most mutual funds, so that is something you would need to watch out for. But other than that, they are quite liquid and flexible. The LSVCCs, they do have a tax benefit to them, so there is that as well. And then the low-cost investment options, that basically means that you can just put a minimum of let's say $500 into certain mutual funds, and you do get all of these advantages. Now, some disadvantages include lack of transparency. So some of these funds, especially ETFs, they do lack transparency, meaning that you won't actually be able to see exactly what is in that fund. They do update it, but usually ETFs are on a quarterly basis, whereas mutual funds are on a monthly basis. So sometimes you won't be able to see what is exactly in that fund at a specific moment in time. The liquidity constraints, that sort of just means that there is a minimum constraint to those funds. Also, some of the liquid alternatives and hedge funds, there is some constraints there. You do need a certain amount of money to have a hedge fund. So there are liquidity constraints with some managed products. The high fees, managed products, they do have costs to them, including MER, basically management fees. And these are a bit high. So typically for a regular mutual fund or balanced fund, management fees tend to be around 2%. So basically, by keeping or by owning a mutual fund, you are going to be paying the portfolio managers, the portfolio company, about 2% per year. So that's on top of all the growth you get, and it will account for high fees. So, for example, if you happen to own the specific stocks within one of these mutual funds, then you would have the same returns plus that management fee that they are charging. And another disadvantage is the volatility of returns. So managed products, they're not guaranteed. They will fluctuate, and there will be times where you might actually lose some money on your investments. However, over time, these always do increase. Now, I am going to be going over the different costs of mutual funds. Now, a lot of mutual funds, they do vary in sort of fees. Some of them have front-end loads, whereas some have back-end loads. But more commonly now, mutual funds have no loads. And basically, I'm going to be going over these. So front-end load, it's basically charging a sales commission up front, and then you also do pay that management fee as well on a fractional daily basis. Now the back-end load, this is also known as a deferred sales charge. So this basically means that there is a sales commission when it is sold. It does depend on how long you have held that fund, and we will be going over an example of the deferred sales charge later. Also, you do have no load funds. These are much more common now. Both the front-end load and the back-end load, or DSC funds, they tend to be banned from the industry somewhat. They're basically no advantage to them except that it does pay the advisor more money. So it does look like they are sort of getting banned from the industry, and we're moving towards no load funds now. And these are much more common. They have no trading fees, so the only fee is that MER fee, which provides the fund company and the advisor a bit of money just to cover the trading costs and things like that. And also, there are a few tax complications with mutual funds. So unless the investor is holding their funds in a registered account, so a TFSA, RRSP, then they will have some tax complications. So if they are holding these in a non-registered account, then they will have some taxable events whenever the fund ends up purchasing or selling some of the securities within the fund, or maybe they distribute some dividends or interest to the shareholders. So that could cause a taxable event, and there would be some tax complications for that. Now, the mutual fund structures, there is two different structures. You have mutual funds structured as a trust, and then also structured as a corporation. Now, the difference here is that investors are either going to be considered unit holders or they're considered shareholders. So for the trust, they are considered unit holders, and it sort of enables the fund to avoid tax. So any interest, dividends, or capital gains will flow through the unit holders. Basically, they will give the investors of the mutual fund more units of the mutual fund whenever they do distribute these distributions. And then with the mutual fund structured as a corporation, this basically is when the income it earns from interest, dividends paid out, and capital gains, they will be sent to investors in terms of shares instead of units. And basically the corporation, they can achieve virtually free tax status by declaring dividends equal to the corporation's net income after fees and expenses, but also they can decide not to do this, and they could retain some of this as profit. Now, the organization of a mutual fund consists of 4 different levels. First off, you have the top level, which is the directors and the trustees, and they hold the responsibility of ensuring that investments in the fund are consistent with the fund's specific objectives. You also then have the fund manager. They're responsible for the day-to-day supervision of the funds in the investment portfolio. So basically, they maintain all the day-to-day operations of the fund, and they do receive a management fee for these services. They also are responsible for calculating the fund's net asset value per share. They also prepare the fund facts and supervise the shareholder record keeping. Now, distributors are basically the investment advisors that sell the mutual funds. So they are independent direct sales organizations or in-house distributors, and they explain the objective of the fund and mail out confirmations, handle client inquiries, and things like that. You also do have the custodian, which is a pretty important part of the mutual fund organization. They collect the money from the fund buyers and from the portfolio income, and they also do arrange the cash distribution and maintain record of who owns the fund's shares. Now, this next slide, we are going to be going into some more calculations and mathematical approach to how mutual funds work. So first off, you do have the net asset value per share formula here. Basically, it is the total assets subtract the total liabilities. So basically just the net assets divided by the number of outstanding units, and that's the basically the share price for 1 unit of the mutual fund. Then we also do have an example of a front-end load here. So this example shows a 4% front load on $1,000 to make it quite simple. So basically you are going to be paying $40 of your investment for the front end load. And actually you would think it is a 4% cost basically, but what happens here is only 960 of it is invested. Therefore, 4.17% of the amount invested was actually fees. So that is quite important to understand and distinguish between the 4% front load. Also, you have the offering price of mutual funds. Basically, they are the net asset value per share divided by 100% minus the sales charge. Now, we also do have an example of DSC fund, deferred sales charge funds, also known as the back-end loads. So these are a bit more complicated. Basically, if you can look at the chart there, a lot of common DSC funds, they tend to follow this pattern. However, it does vary from fund to fund. So basically, if you are going to redeem the fund in less than 1 year, you will have a higher back-end load fund. In this example, for example, you would have to pay 6% back. If it is in the second year, so from the first to second year, the charge is 5%, and so on and so forth. So the example here is if you sell it in year 4, and let's say the net asset value per share in year 1 was 10 and it went to 15 in year 4. So basically what you're going to be charged here is going to be the ending net asset value per share times that 3%. So you can see that your profit is going to be equal to, so as you can see here, if you do sell the mutual fund in year 4, you will be selling it at a price of 15, but because of that deferred sales charge, you are going to be it's going to be costing you about 0.45 of net asset value per share. So essentially, you are going to be getting profit of that 14.55, and then subtract your initial cost of 10. So you are going to be paying about 3% of the ending net asset value per share. in deferred sales charge funds. However, they do tend to reach zero if you do hold them long enough. And now looking at the specific mutual fund fees. So these are often within that MER fee. So you do have trailer fees. These are the annual fees paid out to the fund managers. From the management fees, they are also paid out to sales representatives who sold the fund, and they would receive this trailer fee as long as the client holds the fund. Now, there are some other fees. Some funds do have a sort of setup fee. However, this isn't too common anymore. Also, there are early redemption fees as well, and this is charged if the fund is redeemed within 90 days of the initial purchase. So it could be a flat fee of about $100 or 2% of the original purchase cost, and it only is if you do redeem the fund within 90 days of the initial purchase. There is sometimes switching fees, so some fund companies offer a limited amount of free fund switches, and then after that it may cost about 2%. And then there's also the management fees, or the MER, and this basically accounts for all of these trailer fees, other fees, switching fees within that MER. And then there is the MER, so this does include the trailer fees. It also includes things like trading fees, things like that. And typically, if you are invested in a money market fund, it is, or it tends to be quite low. For example, it could be 0.5%. And the textbook does say it could go up to 2%, but that is quite rare. Usually you'll see it is quite low at 0.5. There is also equity funds. So equity funds tend to be about 2% to 3%. There's index funds as well. These are usually lower than equity funds since they are passive managed funds, and they tend to try and track an index, and you won't need to pay the manager for sort of actively managing the fund. And the MER is calculated as the aggregate fees and expenses payable during the year divided by the average net asset value for the year. Now, mutual fund regulation. So mutual fund regulation is based on three principles: personal trust, disclosure, and regulation. And the MFDA Mutual Fund Mutual Fund Dealer Association regulates how the funds are sold, but they are actually not responsible for regulating the activities of dealers under another SRO. So basically that means that the dealers actually selling these funds are regulated under their own provincially regulated SROs. Now, mutual funds, they do require the following disclosures. So they always require fund facts, a simplified prospectus, annual information form, annual audited statements, and there's also other info such as material changes. Now, mutual fund requirements, as I mentioned, you do require that fund facts document, and investors actually have the right to withdraw from the fund within 48 hours of confirmation of the fund facts. Also, investors, they can rescind purchase if any documents contain any misrepresentation. Now, the simplified prospectus, this is basically a shorter and simpler version of the prospectus, and you can kind of deduct that from the simplified prospectus name. So there is two different parts. Part A includes the general information of the mutual fund, whereas Part B includes detailed and specific information on the mutual fund. The Annual Information Form, or AIF, this includes significant holdings and other issuers, tax status of the issuer, the directors, officers, and etc., as well as any associated persons and any material contracts. Now, there are some requirements for the mutual fund industry. So to become licensed and actually sell mutual funds, you must either register with securities administrators in all. So to become licensed to actually sell mutual funds, you must be registered with security administrators in all provinces in which they operate. Now, you must also have the Canadian Securities Course, which is this one, or the Investment Funds in Canada course. If you do the Investment Funds in Canada course, you can only sell mutual funds, whereas the Canadian Securities Course allows you to sell mutual funds, stocks, also ETFs and things like that as well. Now, the application must be filed with the NRD with the appropriate fee. You must be employed by the distribution company. You're also not permitted to carry on any other forms of employment. Detailed report about your past businesses and employment must be included as well. And you must notify within 5 business days if there is any change in any of your important information, like your address, if you had personal bankruptcy, criminal charges, civil judgment, or a disciplinary action from a professional body. And lastly, just some more restrictions on mutual fund management practices. So mutual funds, they cannot purchase any more than 10% of a single issuer or more than 10% of a company's voting stock. This has to do with sort of owning too much of one company, just because that would make their interests a little bit, make some conflict of interests. Also, no purchase of shares in the manager's own company, no purchase of shares of other mutual funds, except in certain cases where there is no duplication of management fees. So there are sometimes funds of funds that you can buy, and there's sort of the exception to this. There's no borrowing for leveraging purposes, no margin buying or short selling, no commodity or commodity future purchases, and there is limitations on the percentage of holdings in illiquid securities. Finally, fund managers, they are permitted some derivatives to hedge risks, and they facilitate market entry and exit. So it also just cannot be more than 10% of the net asset value of the fund. And so that is everything in Chapter 17 of the Canadian Securities Course. The next chapter, we are going to be going into more in depth into mutual funds, so stay tuned for that.